Welcome to the fifth session in Fundamental and Technical Analysis organized by SE Securities. So in the first four sessions, we discussed about the basic fundamentals of financial statements, income statement, balance sheet, and cash flow. And by now, we have discussed a various number of ratios that an investor should look at. Just a quick recall from what we discussed last week. Last week, we discussed about certain rewards for investing in shares. So we discussed about capital gains, which everyone knows, and we discussed about rights issues and about dividends. So as you all know that there can be two types of dividends, cash dividends and scrip dividends. So that also was discussed in detail. So today what we are planning to do is discuss more about dividends, right? So in the next couple of sessions, we are going to discuss in detail about dividends and rights issues. So let's look at dividends. Now, you all remember, if I just go back, a cash dividend is a payment made by a company out of its earnings to its investors in the form of cash, right? And I also shared that it is not compulsory. However, they may do so at the discretion, at the director's discretion. So along with the dividend, there are certain things an investor should know, right? When a company pays a dividend, what they first do is they announce a dividend, right? So let's start with that. They announce a dividend that is known as the declaration date. So for example, we'll say 1st July 2021, a company announced a dividend. So it will come on the CSC website, a particular company saying that we are going to pay a certain amount of rupees as a dividend to our shareholders. So that the day of announcement is known as the declaration date. Along with the announcement, they will give certain information such as the amount of the dividend, the value of the dividend, how many rupees, and also they will give a date called the ex-dividend date. Now, what is ex-dividend date? Ex-dividend date is the date until which you need to hold shares, or if not, as of the ex-dividend date, you need to have shares for you to be entitled for this particular dividend. So 1st of July they announce, and 10th of July is ex-dividend date. So if you bought shares between 1st July up until 9th July, and if you had shares on 10th July, you are entitled for the dividend, right? So we can say that 9th of July is like the entitlement date. That is, as of the market close on 9th July, you need to have shares, right? So ex-dividend date is 10th July. As of the market close of 9th July, that is one day before the ex-dividend date, you need to have shares. So even if you bought shares on 9th of July, day before the ex-dividend date, you are still entitled to the dividend. And 10th July, in this example, it is the ex-dividend date. On 10th July, you can even sell your shares because you had shares as of 9th of July, which is the entitlement date. So, so many people get this mixed up. Ex-dividend, you should not have shares. There's no point you buying shares on the ex-dividend date. You have to buy shares at least one day before the ex-dividend date, right? Market closes at 2:30. So if you bought before 2:30, a day prior to the ex-dividend date, you are entitled to the dividend. And on the ex-dividend date, you can sell it. Now, after the ex-dividend date comes the payment date. So the payment date is the date on which the company pays out the dividend. So if you have given instructions to CSC or to your broker to directly deposit your dividend to your account, that will come into your account. If not, the company will post you a check to the value of the dividend, right? So normally what happens is when a company announces a dividend, from the date of announcement up until the ex-dividend date, the share price may move up depending on the size and the value of the dividend. And what would happen practically after the ex-dividend date is the share price may come down, right? Not that it will come down, it may come down. So it all depends on the market sentiment, the company's performance, and by how much the share price have gained between the declaration date and the ex-dividend date, right? So this is important because you have to know these dates and you need to keep a track of them. So where can you get these dates? Any investor can get these dates from this Colombo Stock Exchange. If you go to the particular company's particular web page, that is, for example, we'll say commercial bank. If you search commercial bank in the CSE website, it will give you all the announcements made by commercial bank, and you can see the ex-dividend date. If not, there's another file called the stock market daily, which will give you all the XD dates of the dividends which are announced recently. Or if you are a customer of SC Securities, we send out you a daily report called the Daily Market Watch. It also has all the ex-dividend dates, right? So when you're buying shares, you need to have an understanding about the company's past track record in paying dividends, right? So you have to see whether this is a company which is known for paying dividends. There are certain companies, every year they pay dividends, and most of the time those dividends are paid during the same periods. For example, we'll say every month, February, a dividend is paid. Or every month, March, a dividend is paid. So historically, you can see. So if you track that company over a period of time, when you go through their announcements, past announcements, you can see when has this company announced dividends in the past. So based on that, you can decide, is it a good time to buy the shares? Okay, going back to the certain calculations that you need to do in terms of dividends. Now, when a dividend is announced, you have to see what is the percentage return that you can get by buying this stock, right? So that is called the dividend yield. For example, we'll say the share is trading at 100 rupees and the company is paying a 5 rupee dividend. So if you pay 100 rupees and buy this share, you are going to get a cash payment of 5 rupees in the form of a dividend. So when you work out 5 rupees as a percentage of the share price you pay, that is known as the dividend yield. So in this particular instance, the example I took, you get 5 rupees as dividend by paying 100 rupees as the share price. So you get a 5% return immediately in the sense from the date you buy up by when the dividend is being paid. So a 5% yield. So that you can compare with the present market returns. You can compare that return maybe with fixed deposits, maybe with savings accounts. Now in the present environment, fixed deposits are earning yields closer to 5%. So if there's any particular stock which is paying a dividend yield of, we'll say 8%, right? That is a very good investment because you need to keep money in a fixed deposit account for 12 months for you to get 5% or 4.75%. Whereas you buy a particular stock which pays 8% yield, you are better off because you can get a higher return in a shorter period of time. So dividend yield is a key indicator which you need to look at. So you can ask your broker or you can do your own calculation. You can simply see when a company has announced a dividend. You can work out that dividend as a percentage of the share price that you need to pay, and you can work out your dividend yield. As of now, I need not name companies in this particular presentation. As of now, there are companies which have announced dividends and which are paying like way above the FD rate. There are companies which has a dividend yield of around 8%, 9%, right? Which are very good investments. Then the other thing which you need to look at is the dividend payout. Now I said you need to see whether this company is a dividend paying company. There are companies who are paying dividends very consistently, right? And there are certain companies who does not pay dividend. And there are companies who pay dividends on an ad hoc manner. There's no consistency as such, right? So by looking at the past dividends, you can see what percentage of their earnings are being paid out as dividends. That is known as the dividend payout ratio, right? Now, in our first session, we discussed about earnings per share. So if someone has missed that, you can always refer to our previous recordings, which is available on YouTube. Earnings per share is the amount of profits attributable to a single share. That is, you divide your total profit by the total number of shares in issue. Out of that, what percentage is being paid out as a dividend? For example, we'll say a company is earning an EPS of 10 rupees and they are paying 4 rupees as dividends. So out of their 10 rupee earnings, they are paying 4 rupees back to the shareholder. So when you work that out as a percentage, it's roughly about 40%. So this company is paying around 40% of their earnings back to its shareholders in the form of a dividend. So you can work out this for several years in the past and see what is their payout policy, right? As I said, there are certain companies which has a very clear track record. You know their payout ratio, right? That is also very consistent in most companies, right? So when you make your investment decision, please check all what we discussed in our first few sessions, and also see whether this is a dividend paying company, how consistently are they paying dividend, and what is their payout ratio, and what is the current dividend yield based on the current market price, right? All these are important things that one should look at when they are investing in stocks. Now, another thing which I need to touch upon is interim dividends and final dividends, right? You may see when a company announces a dividends, so the announcement would say the interim dividend or the final dividend. What is the difference? Interim dividend is a dividend which is paid out by a company before the annual general meeting and before the final results are being released. That is known as an interim dividend. For example, we'll say a 31st March company may release their results somewhere in May, right? So before these results are being released, if they pay a dividend in January, that can be an interim dividend, right? A dividend paid before their final year-end results are being released and before the AGM. That's an interim dividend. Final dividend is simply a dividend which is being declared after the AGM and after their final results are being released. So normally, typically what we have seen is that the interim dividend would be a smaller component and the final dividend might be a bigger component. There's no rule as such. Typically, that has been the pattern. And certain companies may pay several interim dividends, not just one interim dividend. They may pay like the first interim, second interim, third interim, and after the AGM, they might pay the final dividend. So when you are calculating the dividend payout, you need to get the total of these dividends that are being paid during an year, right? During an year. So that is how you calculate the dividend payout. So similarly, in the case of dividend yield, if you're just targeting and buying a particular stock for a particular dividend, yeah, you can just consider that dividend alone. Or if not, if you're buying this as a long-term investment, you need to see what is the total of their dividends paid for an annum, their annual dividend, right? And that needs to be worked out as a percentage of the price you are going to pay to work out the dividend yield. So dividend is like the interest rate calculation that you do for a normal investment account. Okay, so next week we'll focus on rights issues. There are so many things to discuss under that. Under dividends, we can also discuss about certain dividend theories like dividend irrelevance theory and all that, but I don't see that it is very relevant to the current forum. So we will be basically touching upon the very basic things that are required for a new investor. And I will stop there for today, and let me call upon Mr. Saliya to take over the technical analysis session.
Thank you very much, Charitha. Welcome all of you. It's once again a pleasure to make a presentation in front of you all, and I hope this also will be user-friendly, and it will come in handy for your information and knowledge building. If I am going to take you through, I would like to start with what we discussed last week at the end. If you recollect, this is the drawing that I left with because we were discussing about the candlesticks formations, and in that I mentioned that there are 5 types of bullish and bearish candles, where I define them from most bullish to least bullish, and most bearish to least bearish. At that point, we were here. That was on the 30th. That, I mean, last Wednesday was 30th, and we I requested you all to watch what is going on in the price action up to the next week, that is today. There was a low on these two candles, which I consider them as the second most bullish candles, which is the 30th candle and the 23rd candle, where the low was 48.70 and 48.60. At that point, I kept those lows, and in fact, I drew this area between 48.50 being the low to 53.30 as, sorry, 50 rupees and 30 cents as the high. And there was a question as to what will happen. And then I mentioned that if there is going to be a breakout above 50.30, that is interesting. That is what we have to watch in terms of the bullish side. And I mentioned that we should look, I mean, watch what is going on without doing anything. And today, I would, I would encourage you all to understand how this low and the high areas are behaving, and at the same time, the importance of respecting the breakouts, right? It's very important that we have a feeling when we analyze the price behavior. We need to inculcate, we need to train ourselves, train our minds of the breakouts, breakout above a high point or breakout below a low point. As long as the breakouts are not taking place, you see a thing called a consolidation. In a support, in a resistance area, you have a consolidation. Within a consolidation, you have a support and a resistance area, whether or not it's a support or a resistance level. So this importance of understanding the support and resistance levels in a consolidation is very important. And whoever is following technical analysis right now in the overall market plus individual stocks, we see this, I would say this is happening very rarely, where the market and the key companies, key stocks are within a consolidation. And you have pluses and minuses when it comes to a consolidation. As long as a consolidation is respected, where a breakout takes place above the high price, it will be encouraging for a market like ours, because in our market, we have only one way, traffic, right? If you buy only, you can make money, right? But one day, probably in the very near future, we will see the other way around, where you sell to make money in terms of short selling. Right now, this is a one-way traffic where we buy and we wait for the return to make after selling. So for that, a breakout above the high point or breakout above the resistance is very important. Now, leaving with this drawing, I'm going to take you all through another important aspect in technical analysis, where we will be discussing indicators, the meanings behind the indicators, and the idea behind the indicators, and also how we are going to relate them, or we are going to use them as tools for our analysis. So today I'm starting with moving averages, and as you can see, we will be mostly using the shortened form for these names. That's why I have mentioned the shortened form names. SMA is simple moving average, EMA is exponential moving average, and the WMA is the weighted moving average. These are the three primary moving averages we will be using as indicators when we do our analysis. Moving forward into simple moving average, this is the most used, not only in terms of technical analysis, in other fields of subject areas, we have come across moving averages in this format, which is called a simple moving average. A simple moving average typically uses daily closing prices, but not necessarily so. But we must understand, in the case of our analysis, we are only using closing prices, but ranging from different time frames. Right now, we will be discussing about daily moving averages, but you can have weekly, monthly, or even 1 minute to 5 minutes to even 45 minutes, 1 hour time frames, where we will be looking at the simple moving average. At the end of the new price period, that data is added to the calculation, while the oldest price data in the series is eliminated. Now here, this in order to understand the formula, you can see that there are 5 types of data that we have taken, numbered from 1 to 5. And if we add the new data and we consider number 5 as the oldest data, and the number 1 as the newest data, the moment we include the newest data, number 5 will go out and number 4 will become 5, right? And by adding these values of the 5 period that we are using, the total that we arrive at will be divided by the number of periods. Here in this instance, it's now 5 days, whereas we are adding price values of 5 days and dividing that by 5 in order to get the results of the moving average. Here you have 5 prices here, 5 values of prices, ranging from 90 to 9091. Add it, then divide, you get 90.656, and that is the simple moving average. Now, my endeavor here is not to teach you, give you exercises to understand the formula. That is not the idea of a technical analyst in the present world. Earlier, when I started, because I have a little bit of memory about these moving averages, I can remember in 1994-95 period, or around 96 period, we got hold of the moving averages, and that time we all of us know MS Excel started started to become widely in use. We used to, in accounts departments, in many other areas, people started using the Excel, MS Excel in that oldest format, right? There were a lot of limitations, but with that, we used to do the averaging. It was interesting because the formulas also started coming through for the first time into Sri Lanka. So laymen like us used to it was interesting for us to just keep adding some values and then dividing it. So that was those days. But now you don't need to worry about any of those things, because the formulas are all included in our chart windows, right? I remember on the first day we showed you the chart window and where are the indicators and stuff like that. So this endeavor is not to take you all through working out the formulas or giving you homework for formulas. It's the concept that is what is important, not only for moving averages, but the next in the next sessions, when we are discussing about the other indicators, we will be brushing through the idea. And as long as you get a hold of the idea, the secret lies of how you are using those ideas personally, right? sometimes that that understanding which relates in or turns into experience will make you stand ahead of another person using the same average. In the case of simple moving average, if you understand how to read it the way you have experience and successfully done it, right, you will be ahead of another person who is using the same thing, right? That is the beauty of technical analysis, right? So get the idea of these indicators and the future indicators as well. So moving on to the next one, I'm taking you all through the weighted moving average. Now the other one, simple moving average, you take the values, total them up, and divide by the number of that particular period. Here, in the weighted moving average, you assign a heavier weighting to more current data points since there are more relevant. Since they are more relevant than data points in the distant past. The sum of the weighting should add up to 1 or 100%. So that's inside the formula. But this is how the formula looks. WMA equals price 1 into n plus price 2, etc., etc., and divided by this n into 1, n plus 1 divided by 2, and the n is the time period. If you take the same price point that we used on the previous formula, where these were the price points starting from 1990 to 1991, you have 1990 considered as the latest figure, and this is the oldest figure. So for the latest figure, we have a weightage of 5/15, whereas for the oldest figure, we are giving a lesser weightage where it is 1/15, giving a total of 90.62. So in other words, this is, whenever there are price changes, bullish or bearish, right? The moving average, the weighted moving average will show a prominent, kind of a clear indication of that, positive or negative variation compared to the simple moving average. The next one that I must also mention, weighted moving average mostly aren't used, right? But there are you can always include the weighted moving average when you're using when you're wanting to include it to your analysis. It depends on the individual. The next one is the exponential moving average. Now, exponential moving average is also something similar to the weighted moving average, where it adds in a weight towards the most recent prices, right? But the rate of decrease between one price to its preceding price is not consistent, and it is exponential, right? So as a result of that, what the bigger picture of the exponential moving average also we need to understand is that in this you can use the exponential moving average to find out or to give you an indication that the EMA is giving you a smoother indication, smoother average, inclining more weight towards the latest price behavior than the previous price behavior. So whenever there are spontaneous or whenever there are positive or negative movements in the price, the exponential moving average will be behaving more quickly than the simple moving average, right? But that does not necessarily mean that all these three are, having different advantages or disadvantages. Only thing that you need to understand is that you shouldn't be complicating yourself by, putting all these three in different time frames, and you think, okay, all these three are useful for me, and then I'm going to use all these three, right? You can do that, but that confuses your mind. So because of that, it will be more advisable, and probably that is the reason as to why many in the world, from the best of technical analysis, concentrating on many developed markets to very underdeveloped markets, right? All of them are using a set of moving averages in their analysis. If they're going with the exponential moving averages, if they feel comfortable with it, they go by that. If it is simple moving averages, they do that. And also weighted moving averages, right? So we need to understand that aspect of it. If you take, rather, if you consider key takeaways from these three moving averages, any of these moving averages are widely used to smooth out price trends by filtering out the noise from random short-term price fluctuations, right? It smooths out the noise and the vulnerability of fluctuations. The moving averages can be constructed in several different ways and employ different numbers of days for the averaging interval. You can have many types of periods, intervals, and use them. At the same time, sometimes you can use the simple moving average and exponential moving average to understand the shorter time frame price behavior as against the longer time frame price behavior, or something of that sort. So you have that facility of using the moving averages the way you want. But the common applications of moving averages are to identify trend direction and to determine support and resistance levels. Now, this is the most, it says the most common application, but these are the important applications of the moving averages. The reason as to why we are using the moving averages are to understand the direction and to use them as our support and resistance levels. When asset prices cross over or below their moving averages, it may generate a trading signal for technical traders, right? We are going to look at this crossing over the a certain indicator or crossing below that indicator, how it works, and at the same time how we can generate those signals as technical analysts or traders, or by using these charts. While moving averages are useful enough on their own, they also form the basis or foundation for other indicators and tools to design your analysis. That also we will be doing when we start covering those indicators, and we will be combining those indicators along with moving averages to understand what is going on. At the same time, the foundation or the basis of the moving averages, idea behind the moving averages, the formulas behind the moving averages are used in order to further extend in creating another indicator. Basically, these indicators or the moving average concept acts as a foundation to derive another indicator, to extract another indicator with a few more extensions added into it, right? We will be looking at things like MACDs, that is moving average convergence divergence. Then you have the Bollinger Bands. Again, we are using the average as the formula. There are indicators of that nature which are where the moving averages have formed the basis or the foundation for those indicators. Now, since we have time, let's go to a chart and show you how we are using the moving averages for when we are analyzing the buy and sell triggers. Right now, this is the Expolanka. I'm going to start with this. I will be changing the name because I would like to keep this followed. I'm going to change this name to a new chart, Expo MA Study. Right? Now I'm going to take this out. Right. So let's enlarge this a little bit. Right. We'll keep it there. And we are going to include the simple moving averages. First of all, the simple moving average. Now, under the indicators, you can even say MA here on the search, right? When you say MA, you have the moving averages. This is the indicator I'm talking about. The simple moving average in this platform is known as the moving average. So I'm taking the moving average, only one, since we want to study this. By default, right now over here, you can see the details of the moving average. Now here you have the details of the volume indicator that is given here. Earlier also we saw that. Right. So in the moving average figure details, the first thing that you need to understand is if you just load it, you get the current moving average value, right, which is 4961. Right? That is what you will get. But if you move the cursor, you will see that the value changes, right, as per the date that the mouse is resting. Right. Then the other thing that you can see here is that that these values, 9 is the number of periods, meaning this is, since this is a day chart, it is calculating the average by using values of 9 days. And it is taking the close price as the price data, right? 0 is just, it doesn't add anything further into the calculation, right? So you can you can go ahead to the format button in the indicator, and you can immediately change this default date into different numbers, right? Default date is 9, so you can change it to different numbers based on your preference. In my case, for my personal analysis, I use as a short-term period as 5 in a day chart, because we have 5 market days for a week. So when I'm taking the 5-day average, that means technically we are talking of the average for a week, right? Then the longer, meaning a little longer than the 5-day, I take the 20 period as the value of the period. The reason for that is because for a month you have 20 market days, right? Leaving aside the holidays in between, you have 5 working days and 20 working days for a month. So when I get the value of the 20-day period, I know that that's the monthly value, right? Before combine, why I'm taking that 20, and I mentioned about 90s, when we are combining 2 moving averages to do our analysis. Before doing that, let's go ahead with this one indicator where the 9 is your value for the number of days. And let's see, let me make this line a little bit visible by bringing it to the actual color and also the width. Let me enlarge it a little bit or thicker it a little bit further, like this. So you can see it now. Okay. The idea here, as I mentioned, right, we use moving averages most commonly to understand the crossover or below the price, and also to use it as a support or a resistance line, right? So if you just stay focused onto this area, that is during the latter part of December of 2020, the prices you can see are moving in tandem with the price line, the average line, right? We incidentally call the prices the price line and the moving average line as the MA line, right? So the price line and the MA line is going in, moving alongside each other, but there is an increase of the price line compared to the moving average. That is called a crossover. Crossover above the moving average. The price has crossed over above the moving average, right? So that is known as a breakout, right? Thereafter, we can see the next thing I mentioned is the support or resistance. When a price is going up or coming down, in this case, it is going up, right? So many times there is a thing called retest. It goes up, throws back, goes up, throws back, rallies, pulls back, right? So let's see the rally and the pullback here. There is a rally, 2 days, pull back, going sideways, then a rally, pulls back, a rally, pull back, a rally, pull back. So when these rallies in an uptrending movement, the other basic is also very important. What is the other basic? The most important basic is the higher low, higher high formation, right? Why the higher low, higher high? The low becomes higher than the previous low, and the high has to break out the previous high, right? To make it, for it to become the higher high, right? So that is needed when an uptrend has formed, right? Just because the price has jumped ahead of that average doesn't mean that the prices are going to run crazy to the levels that we can't even imagine. That won't happen, right? Just because there is an average line that we have drawn, just like that trend line that we are drawing, just because those lines are drawn or these indicators are loaded, the prices are not going to jump up and down. We have to remember one thing. Thanks to prices, only we have all these things, right? If the prices are not there like this, that you can't see this, right? That because this is here is because of the price. Remember that. So in the case of the moving averages, when the price crosses above the moving average and starts extending with the higher low, higher high formations, the moving average line is going to act as a support line until such time it crosses below, the price crosses below, right? As long as the moving average line acts as a support line, we can keep on adding into our buy position, right? We have to understand that. For an example, you see a cross here. Let's say you were confident enough to take it at this level. Why you should be confident enough is because just because there is a jump above the average doesn't mean that you should be buying. You have to look at the other side, because the prices, you know, the previous price respect is always there. If this price jump respects the previous high and rejects that previous high, then you know, it's not going to work in our favor, right? So we have to understand, okay, there is a breakout, cross above, where is the breakout? Crossing above the moving average doesn't mean that there is a breakout of the high. So this high is 2730. You go back and see the other highs. This high is 2650. Obviously, it has broken out, right? So that's a positive thing. Then look at this high. This is 2760. Here it's 2730, right? The next day went up to 28, breaking this, but it came down. It came down to this level. Now, when it is coming down, you have to look once again at the previous highs and the moving average value. And if you see that there is a support building up around the moving average, then if you had trained yourself into using the moving averages in your trading, right, then you will be using it to add more positions into your buy side, right? Let's say you have bought here, that because of this 28 breakout above 28, rather 2760, and went up to 28, then you feel there is a consolidation respecting this area, right? And it's not coming down. Then you see for several days, the prices are above the moving average, you add to your position. Then it goes up, comes down again. But at this point, it has broken out of this level also. Then once again, there is a respect here. At this level or here, you can start adding into your position, right? And then it goes up, comes back again. Again, there is a support building up here. Then breaks out, trends up again. At this point, that cross below happens. Here it's a crossover, it is a cross below, right? So once the cross below happens, the same thing that we saw when the prices were going up, went up, came down, went up, came down, rallied, pulled back, rallied, pulled back. Here there's a pullback, then it has to rally up, then pulls back, rally up, pulls back, rally up, pulls back, rally up, right? So when you're studying this, training your eyes of how this moving average is behaving, you will understand how the prices are respecting this 9-day moving average, right? Since this 9-day moving average has been a popular short-term time value, right? By default, the software developers have used it as 9-day, but you can, change it to your own purposes and your liking, right? So this is the moving average, the simple moving average, how it behaves, right? And let's see how the EMA is behaving in the same period. Okay, EMA. So we go here and just type EMA. You will get moving average exponential. This is what is known as the exponential moving average. So you have the same period of 9 days, and let's color this in red. In the case of the 9MR, right, I mentioned that it gives a weight to the latest figures than for the oldest figures. The newest figures, it gives you a better weightage. As a result of that, you can see that the MR and the SMA has a difference, right, in the same time period, but the formula is giving you different figures, right? In the case of the SMA, the value, the present value is 49.6. The MR's value is 49.3, right? But at the same time, the rules of the crossovers and support and resistance will be the same, right? If we take the SMA out, and you keep this as your moving average, you will always look at those crossovers and cross below the same way that we were looking at in the SMA. At the same time, how the prices are respecting the support and the respecting the moving average line as the support and the resistance, right? So that's how we use the MR and the SMA, right? Then let's take the weighted moving average, right? Let's say WMA. We have moving average weight. Okay, so this is the weighted moving average. Let's take this, change the color. The reason as to why I am showing you all these, if you all are still beginners, if you are professionals, I don't think I need to elaborate on it. But if you're a beginners, then you yourselves can, go into these formats and play around with them. Nothing wrong. Sometimes, when we were doing it, sometimes they just vanishes and we don't know how to take it up again. Then all what we do is we just go here, click it out, and then move along with a new format, right? Don't worry about it. Just play with it. You can draw any way you want, as long as you get the idea, right? So we'll shut the MR9 out, and this is the weighted moving average, right? So in the same basis, where when the price crosses above, then you see the weighted average line is acting as a support, right? When the prices are uptrending, it acts as a support. When the all the moving averages are like that. When the prices are trending down, it acts as the resistance line, right? So the next thing that we need to understand is that is very important. We should clearly remember that at a time of consolidation, at a time where the prices are going sideways, at a time where you don't see a direction, a rally, a strong rally, none of these indicators will help you, right? This idea of, the price going above or crossing above, then you buy, then crossing below, then you sell, right? That will work only when the stock is trending, right? That is the limitation you have. That some used to say, we are not fortune tellers to tell where the prices are going up. But if you're a real technical analyst, right, you have tools to understand, the basic tools to understand whether it's worth taking a buy at that point, right? Before you even thinking of putting the buy order, right? You have, okay, a crossover, then you can figure out, okay, now here crossover is there, right? Now what the next thing that you need to understand is the breakout from the previous highs, right? So you have a previous high here, previous high here, previous high here, and previous high here, right? All these have to be broken out. Now here it has broken out, right? The highest high based on the previous levels is this. This is 30 rupees, right? Okay, here the close is 27 rupees. So immediately go to this tool, right? Take the price range, just do something like this, go to the settings, make the low as the 27, which is the present close of that breakout point or the cross above point, and the high is 30. What is the value? Is it worth? There is 11% projection. If you buy at 27, that is the 27 is the closing price here. So you put a GTC order at 27, expecting the price to hit 30 rupees, giving you 11% return. So taking that 2.5 away, for the brokerage, still you will have more than 8% return. So is it worth? In Charitha's presentation today, he was mentioning about the dividend yield, 8% dividend yield, right? Within a short period of time, if you get 8%, you don't need to park your funds in the bank. Why? They are going to give you only 4.5%. 4.5%. Recently, I mean, today we saw one of our friends sharing a survey done by Standard Chartered Bank Global Research Division as to when the Sri Lankan government is going to come out with an interest increase. According to their statistics, their surveys, their research, they think there will be a 50 basis point increase only in the second half of 2023, right? There are a lot of economists in this country who think that tomorrow is the 8th, there is going to be a rate hike. They are economists. I'm nothing compared to them. They are qualified people, right? They think there is going to be an increase, right? So let's wait and see tomorrow if there is going to be a rate hike, how much that is going to be. Then what will happen to our FD rates? Will it go up? Even if they go up, will it go up to 8% in 1 month or in the shortest time period, right? If you look at this area, right, how many days it took to go up from 27 to 30 rupees? How many days? This is 2860. This is the day it went up. We broke out and went up. This is on the 4th of January, right? So let's go here and look at the date range. Right here, it's 27. Here, it's 31.50. 7 market days. So what I'm saying is, if you use your expertise, if you use your talents, if you use your experience, knowledge, and your training to understand how the price behavior is happening, right? Within those fluctuations, within those waves, you have the opportunity, right? We are teaching you here to use this, increase your frequency of attaining your return on investment targets by amalgamating your own inherent talent, knowledge, and all your capabilities. That is what the ultimate goal of all these sessions. We are giving you the rod to catch the fish, right? And it is up to you to train the rod with your expertise. And with that, I'm going to conclude my presentation today. And next week, we are hoping to come up with another interesting indicator for you all to include. And let's see with the moving average, how we can use that indicator in order to, hone it or fine tune our analytical journey. So thank you very much. And I think we will be opening the session for you all to ask any questions. If you have anything, you're free to, throw them in right now. Feel free to ask questions. Okay, if you all don't have any